Yeah, I'm just checking. You guys have any questions? All right, Bill, you got a question? Great. Yeah, how you guys doing? You got any questions? Okay, Bill, you got a question? Sure. Sounds good. Well, a lot of times if I stop by, people will ask a question, but when I'm sitting up there, they won't. So if I just take a minute to check in, it really works well. I just have to take a look at the schedule. That sounds about right. You're gonna write that down. Let me give you the right answer. By the way, did you get the schedule and everything?
Sorry?
Did you get the schedule okay and everything?
Yeah.
Okay, no, and that was an honest, question.
Yeah.
For reading it. All right. Okay. Yep, it is October 21st, right in the money. Because he wrote it down, I thought I better be sure. I'm just checking. You guys doing good? You guys doing good? Ready for some 3-3, is that what it said? Okay, we'll do that. I'm just checking it. You guys doing good? You all got a question? Oh, sure. You guys doing good? How you guys doing? Good, good. Sarah, you doing good? Good. Oh, did you ask me about putting this thing online? Is that you that asked me? Okay, somebody did. Never mind. Okay, all right. Hey, you doing good?
I'm doing great.
All right, good. You should be, and yeah, the other guy. Are you guys doing good over here? Okay. You should be on that question. Just checking if you guys doing good. All right, so here's the first one on 3-3. Ready for some more answers? You ready for some more answers? Yep. Sounds good. Here you are. Is that enough? Is that too many? Here's the last part of that. If I do this, look at the most of the board. And here's how they calculated the prepaid insurance, and here's the office supplies. All right, you guys doing good on that? Any questions, comments? All right, we covered a lot of material in here. You guys hold up okay? All right, let's do this. Let's go ahead and have a review, move it in long-term memory. Now, before I start, are there any questions on any of this? Okay, let's go ahead and have a review. So, what we're doing in here is we're doing the adjustments, right? Now, why do we do adjustments? What's our main concern? It's the income statement, right?
It's the matching principle. Because we want to match we want to put the revenue and the expenses in the time period, in the accounting period when they occur. And why do we do that? So we can match them to the revenue in the same period, right? Okay. Now, what are the two kinds of accounting? Accrual and cash. Sure. What's accrual? How does it work? When do we recognize revenue? Okay, we earned, sure. When do we recognize expenses? When incurred, exactly. With the cash, when do we recognize revenue?
When paid.
When paid, sure. When do we recognize an expense? When paid. All right. Now, the advantage to the accrual method is it honors the what principle?
Matching.
Matching, sure. So, and adjustments are part of the accrual basis because we put the revenue and the expenses in the period when they occur, regardless of when we receive the money, and then the expenses match the revenue they produce and the income statement makes sense. Okay? All right. Why would we use the cash basis? Less bookkeeping, right? Because with no accounts receivable, no accounts payable, you leave a step out. And if you never receive the money, it's not revenue. Okay? On the accrual basis, you'd have an accounts receivable, and then if you never receive the money, you'd have to write it off as a bad debt expense. On the cash basis, if you never receive the money, it never shows up as revenue. The effect is the same with a fraction of the bookkeeping. Okay? All right. Now, assets are often prepaid expenses, right? So, when you see an asset as a prepaid expense, that's deferral, right? Now, what happens to this thing? So if you buy an insurance policy, what do you debit? Or prepaid, pretty close, prepaid insurance. As you use it up, what do you debit? Insurance expense for the amount that expires, right? Supplies. When you buy it, what do? You debit supplies. Then at the end of the accounting period, what do? You go to the supply cabinet and you take an inventory. Then you subtract what's left from what you bought, and that gives you the expense. You credit the asset, debit supplies expense. Sound good? All right. Now, what is depreciation? A physical thing is used up, right? So it can be wear out, it can have exposure to the elements, or it can become obsolete. Okay? Now, does market value come into play in any of this? No. It's an asset, you use it up, its market value is generally not relevant. Okay? There can be exceptions to that, such as a portfolio. Okay? Now, with depreciation, what do you credit? Accumulated depreciation. What kind of an account is accumulated depreciation? Contra. And a contra account is a valuation account, right? Now, why don't you just credit the accounts itself? Like, remember we had prepaid insurance and supplies, we credited the account. Why don't you do that with depreciation? I mean, what's with these extra steps? They just kind of confuse people. This is some of that accounting. Well, it is because it's by estimation. You won't know how much values have been lost until you sell the asset. But because you have to do the income statements in the interim, you estimate how much was used up. Okay? Because it's by estimation, you set it in its own account as part of full disclosure. Okay? All right. So you buy the asset, you debit the asset. As it's used up, as it depreciates, you debit depreciation expense and get credit accumulated depreciation, right? Boy, we're never going to miss a break again. Everybody's hanging on for dear life. Look at you guys are thinking, we'll make it out of here yet. Oh, you should have seen the way Katrina chuckled with that one. It really, yeah. Okay, all right. Okay. All right. So, again, and how do you figure depreciation? It's cost minus salvage value divided by its useful life. That's straight line. That's how you guys will do it in this chapter. Okay? All right. Now, accrued expenses, right? So what an example of accrued expense was wage expense. So what you do is you take the amount of expense that occurred in an accounting period, and that's an expense in that accounting period, and it's matched with the revenue it produces to get the net income for the accounting period. So if you debit salaries expense, what do you credit? Salaries payable. Okay, then on payday, you pay the whole thing. In here, how many days will there be in a year? 360, what's that called? Banker's year, okay? So it's 360. How do you figure interest? Principal times rate times time. Okay, that'll be the interest expense. Okay, now, if you are going to be paid after the job is completed, what do you do at the end of the fiscal year? You estimate how much you've earned, and that shows up as revenue. And then it will be some sort of an asset, some sort of receivable. Often accounts receivable is used, although accounts receivable technically it should be no business. All right, so we have accruals and deferrals. What's the difference? The difference is the timing. So with an accrual, what happens to this is you recognize the transaction as we did here, and then you pay it later. With the deferral, as with depreciation, you pay for it first, you buy the car, and then you recognize the depreciation later. That's the difference between accrual and deferral. At one point in time, that was really important. It's not so important anymore. All right. When you receive a prepayment, what is that? It's a liability, some sort of unearned revenue. It's unearned because you haven't earned it yet, and as you earn it, then it's converted into a revenue. How's everybody holding up? You guys will never miss a break. No, this is just, yeah. All right. We'll make sure you get your breaks in. All right. You guys doing good? All right. Listen, nice job. We covered a lot of material. Any questions, comments, on anything? All right. Hey, listen, we'll see you Wednesday. Is that good? Evelina, that sounds good? Okay, let me show you here. So in this case, what we have is for a year. So we divide this by 24. Did you already do that? No.
I don't remember the number, but by December 31st, 2021.
No, this is 2011, and this is 2010. Here's how this works. Excuse me. Let me show you. See you guys Wednesday. Okay. So you bought it on, I'm just going to move it here right now. So the way this works is you bought it on April 1st, 2010. Here is January 1, 2011. Here is December 31, 2011. And then this is, so what happens is you bought it here. Now all you want is how much expired in these 12 months is what you want to record as the expense.
Just those 12 months?
Just those 12 months, because it's this fiscal year that you're worried about. So the way this will work is, let me get out a calculator here. So, and by the way, anyway, so let's take a look here. So we have 15,840. So if we have 15,840, okay, we divide that by 24. That means every month 660 is converted into an expense. So in these 12 months, the amount of insurance expense you have in this fiscal year, 2011, will be 12 times that, which comes to 7,920. So for this one policy, right, this is the amount of insurance, and this is the amount. So what you do is you credit prepaid insurance, and you debit insurance expense. And we just chose the first one. Does that make sense?
Yeah. So if there's 3 of them, is it gonna be 3 separate?
Generally, they're all the same. So what you do is, this is for one of the policies.
Mhm.
You found how much expired in each of the other two and
Then
add
you
that
add them
together.
and then you just make one.
Mhm.
Okay.
Now, I think the best answer I can give you is, what we're dealing with here is the general journal, right? What you do is, there's also with various schedules. And so what it is each of these insurance policy has its own schedule. So that sort of detail is kept in the schedule. And so you have policy A, and it'll say when you bought it, how much you paid for it, how long it is, how much was used up in this year, how much was used up in this year, how much you have left in the next year. Then you'll have, then in the schedule, you have policy B, and it'll do the same thing. And so the answer to the question is, that's where that level of detail is kept. In the general journal, you add the 3 together. And I think that's a good answer for
All
your
right.
question.
For the dates on this one in the general journal, do we just do December 31st? for
Because
all
that's
of them?
at the end of the fiscal year is when you do it.
Okay, so basically you just want us to keep track of A, B, C.
Exactly. So what you'll do is, in your general journal, you just write the word adjustments, and A, B, C, D, etc. And just do them here. All right. You're sure welcome, and keep up the good work. Go ahead and get all this erased.
Do you teach another class right after this?
It's 2:02 and it's this afternoon, so it'll be 1 o'clock. And then the other section, 2:02, is Tuesday, Thursday, or 2:01, this Tuesday, Thursday. And I'll be sure to mention, if anybody ever misses